Hello everybody, welcome back to another Market Dash video. And today in this video, I'm going to be going over 5 stocks that here on our top rankings on marketdash.io I think are good plays. So taking a look at the top rankings here, the first company we're going to be looking at is UnitedHealth. So taking a look at UnitedHealth here, we can take a look at the fundamental analysis. As we can see, UnitedHealth Group is positioned for durable growth despite 2025 headwinds. They're still expected to record very resilient growth, especially in the revenue. The only main problem with this company is the margins, and that could be very bad, but I do expect their margins to get back to normal. Their margins have dropped nearly 50% this year. But as they start to reprice their plans, if you didn't know, the main reason for UnitedHealth with their margins in their sell-off in the stock is due to their mispricing of plans, which has costed them a lot of money because the medical costs have in turn risen while the pricings were pretty low. So that has really hurt them. So they're going to have to reprice. It's going to take a few years to get back to normal, but I think this is still good. As we can see, analysis of recent news, 2025 guidance revision and outlook. UNH revised its 2025 earnings outlook to be at least $14.90 per share and adjusted earnings of at least $16.25. So this was a huge decrease from just the beginning of this year, which was near $30. So it's nearly a 50% decrease in earnings per share expected now. So that's very bad. That's all I gotta say. This is not good for UnitedHealth, but it does look like it in the stock. The stock is down about 40%, 50% since its highs, so it makes sense. But yet the strong top line growth still is there. The revenue continues to grow fast, up 12% year over year to $113.2 billion. So that is very good. Also, the dividend looks very good. They continue to increase that dividend. Taking a look at the in-depth company analysis, financial strength, revenue, and earnings, UNH's 2025 revenue outlook is $445.5 billion to $448 billion. So with an adjusted EPS of at least $16.25. Like I said, the valuation, UNH trades at a forward P ratio of only 19, so this is a very low area, with analysts targeting a 25% upside. And plus, taking a look at the industry trends and competition, competitive position, market leadership, as we know, most people know if you're in the United States, this is the largest U.S. health insurer, so they have unrivaled scale and brand strength. As you can see, they have United Healthcare, which is the insurance. They also have Optum Health, which is care delivery, Optum Insight with the data analytics, and Optum RX Pharmacy. So they have vertical integration into this company where you don't really have to go outside of United Health if you have any medical problems. That's the good thing with this company, and that is what I like about United Health. So that's the first company. Taking a look at the next one, we have PayPal. PayPal is poised for rebound, undervalued fintech giant with strong fundamentals. Despite recent share price weaknesses, PayPal stands out as a fundamentally strong, undervalued leader in digital payments. As we can see, going down to here, analysis of recent news and events, Q3 earnings beat and upgraded outlook. PayPal delivered a strong Q3 report with EPS rising 31% year over year and raising its 2025 guidance, which is very good for the future of this company. Also, they just started a dividend. They just announced their first dividend with that recent earnings report, so you can also get a dividend with PayPal now. AI and product expansion, they're starting to get into ChatGPT OpenAI, and they're starting to invest in that area with commerce, plus strategic partnerships, and the share price has been doing pretty bad, so you could be getting this at a pretty good valuation. Fundamentals and valuation, PayPal is trading around $67, significantly below its estimated fair value of $105, trading at very attractive multiples of a P ratio of $13.29, plus some decent profit margins. But taking a look at the industry trends, digital payments growth, global e-commerce and digital transactions continue to expand. Everything continues to expand. Venmo's doing good, which if you didn't know, PayPal owns. But I think the biggest problem here I want to take a look at is the risk and sentiment, competitive pressure, intense competition from fintechs Block, Stripe, and tech giants Apple Pay. Also, regulatory headwinds is very bad for this company. Now, let's take a look at the third company. We have Alibaba. Alibaba here. If you didn't know what Alibaba is, they're basically the Chinese Amazon with e-commerce, AI, cloud computing. So they're very similar to Amazon, but in China. Take a look at the analysis. Strong earnings momentum showed about 7% year over year revenue increase to about 32.58 billion, and plus 22% jump in adjusted net income to 4.11 billion. So this earnings looks pretty good. Analysts continue to upgrade. AI and cloud expansion. The company's cloud business saw 26% revenue growth, with AI related product revenue achieving triple digit growth. So the AI and cloud expansion is huge for Alibaba to potentially get another revenue segment that can help grow this company. Taking a look at the revenue profitability, full year 2025 revenue grew 6% with net income up 76%. So the net income is doing good. Core e-commerce business is also doing good. The valuation is also very low at about 17 to 18. So this looks good for this company. Industry trends and competitive position, AI and cloud leadership. Alibaba's aggressive investment in AI with cloud revenue growth forecast raised to 30% is going to potentially help this company a lot. But key risks is the US-China trade tensions. And I think the biggest risk with Alibaba is just that it is in China. So you got to be a little bit worried because there's a lot more restrictions since it's not a real capitalist country. So you have to be worried about those restrictions on Alibaba, and you just got to be worried about that. So that's the third company. The fourth one is going to be Amazon. Amazon is demonstrating robust growth and operational excellence, outpacing peers through aggressive investment in AI. Looking at this Q3 2025 earnings beat, they had a very good earnings beat. Net sales of 180.2 billion, up 13% year over year, and AWS continued to grow at 20%. So AWS continues their main profitable segment of their business is still growing very fast, which is helping the EPS continue to grow. Also, AI driven growth, strong fundamentals. Amazon, I honestly think you can't really go wrong with this company. So there's nothing to be too worried about Amazon. Double digit pace, everything looks pretty good. But I want to take a look at the main risks. Short-term margin pressure, heavy capital expenditures, and AI investment could potentially reduce those margins. Also, competition. AWS growth, while strong, has been lagging across the board compared to other cloud companies with Microsoft Azure and Google Cloud. So that could be a slight issue. But looking at the economic moat, they have a very wide moat. Amazon's advantage include network effects, cost leadership. This company has such a large moat. I don't think you can go wrong. And I also want to add, I think Amazon could be a huge company in terms of robots. If they can implement robots into the business and have them work instead of us humans, I don't think they're going to have all robots working, obviously. I highly doubt that, but if they can get rid of some of these workers from today, obviously it's not going to be good for the job market, but for the company itself, that will help them in the future in terms of profitability and their margins, which will increase their net income, which will be great. So with that being said, looking at the final company here, we have Adobe, which I think is a pretty interesting company. While there's some negative sentiment around this company, the financials still continue to be resilient. As we can see with Adobe stock, though, it has declined 35%. The stock continues to pull back, even with earnings beats and increase in their guidance. Posted a EPS of $5.31 and issued full year guidance of EPS higher. So they continue to increase this growth. They continue to have higher guidance. Everything's looking good for this company, and they're also investing in Firefly and Gen Studio for their AI investment. With the profitability, they have a very high net profit margin of 30%. Cash flow looks good. Balance sheet looks very good. Very healthy debt to equity ratio. And their valuation's insanely low at about 14 forward P ratio. Plus, the revenue growth looks pretty good, 10.7%. Everything looks good for Adobe, I think. Adobe looks very strong. Everything looks good for Adobe here. I think Adobe is just... Do you really think Adobe... Will this company be affected in the future by AI, and will this company be able to continue to grow? If you think they can continue to grow and AI not really affect the market share of this business, I think Adobe looks like a great company to buy. So if you guys please subscribe to Market Dash, and this is the end of the video. Please subscribe. Like I said, press the like button, comment down below, give us some feedback. If you want to go join marketdash.io, you can go join it. Also, if you want to go join the newsletter for Market Dash, marketdash.io to get some updates on this on Market Dash. So thank you guys for watching, and see you.